So involuntary conversion is, I'm talking about if you lose timber in an involuntary conversion, you may be entitled to an income tax deduction. So this would be things like a casualty loss. You have a mental image of a casualty loss or a non-casualty loss, a theft loss, or a condemnation. What we're not talking about is a net operating loss where your expenses exceed your income in a given year. That's unfortunate, but you don't get a deduction for that. So there's some general rules that I'll talk about first that apply to all types of involuntary conversions, and then I'll talk about the individual types of involuntary conversion one at a time. So these deductions are available to all owners who hold timber to produce income, whether it's as an investment or as a trade or business. So it's not limited to just people that are active in the trade or business. For the loss of shade trees or timber that's held for personal use, though, for example, yard trees, you need to see these IRS publications, not this talk. So the publication 547, Casualties, Disasters, and Thefts, which is the main source. But there's another one. There's a non-business Casualty, Disaster, and Thefts Workbook, not Ag Handbook, but IRS publication 584. And then 2194 contains these two together already for you, and then the forms. So it's just kind of bundled up for you. The deal with this is there's really no good news about casualty loss. If you have the idea that there's some big pot of gold at the end of the rainbow, that's just not the case. It's all bad news. There's just one aspect that's a tiny little glimmer of not as bad as the rest of it. So I'll make sure and highlight that when we get to it. Okay, deductions only allowed if the trees are destroyed or so severely damaged that you have to remove them and start over, not stare over. I mean, I can imagine you staring over after the fire or ice damage, but having to remove them and start over is what needs to be there. Lesser levels of damage, natural levels of mortality, and normal losses from disease and insect, the kind of background level, are a cost of doing business and cannot be deducted. Also, the amount that you can deduct is limited to your adjusted basis that you have in the timber, which almost never equals its value. All right, first of all, because timber grows, and second of all, because a lot of the stuff we've been talking about earlier today is ways to decrease your basis in the timber, right? To write it off as soon as possible. So there's lots of situations where you'd have very low or even no basis in your timber. So if you lose it, there's no deduction because there's no basis. The loss must be physical in nature. It must be fixed in time by an identifiable event or combination of events. So there needs to be some particular thing. And the event or combination of events that caused the loss must have run its course. So it must be what they call a closed and completed transaction. So taken together, these rules mean that the loss of potential income is not deductible. For example, if an ice storm damages rather than destroys your timber so its growth is slowed or its future value is diminished, for example, because if all your trees have a crook in them 30 feet up off the ground, right? Because the tops got broken out, you do not have a deductible loss. Or if fire destroys pulpwood-sized trees that you were managing for saw timber, so you were managing more intensively than you would have for pulpwood, right? You still must base your loss deduction on their value as pulpwood because that's the product that you lost, all right? Not on some discounted value for them as saw timber. Okay, now let's look at the rules for casualty loss by itself. So a casualty loss is caused by natural or outside forces, and it needs to meet 3 tests. So for a casualty loss, it must be sudden. That means swift, not gradual, not progressive. So insects and disease, even an epidemic, isn't going to count for a casualty loss. It needs to be unexpected, something that you wouldn't ordinarily intend or anticipate. And it needs to be unusual, not something that's a typical day-to-day occurrence. Okay? So this includes things like fire, ice, hurricane, tornado, high wind, earthquake, volcanic eruption, sleet, hail, plane or auto crash, or shipwreck. So if your timber is destroyed by a shipwreck, okay, there's no question it's going to qualify as a casualty loss. Now down south I can talk about volcanic eruptions, but up here I can't talk about volcanic eruptions. It usually does not include things like disease and insect infestation, drought, or combinations of factors. There is a revenue ruling that deals with a southern pine beetle infestation that killed yard trees over a period of 5 to 10 days. So the insects just converged on the trees and literally ate them to death. All right, that did qualify for a casualty loss. But a southern pine beetle attack in sawtimber trees that killed the trees over 9 months did not qualify as a casualty loss because it wasn't what? Sudden, right. If the losses are heavy and the timber is not salvageable, you need to adjust your timber accounts to reflect the loss of volume. And you saw in Form T Part 2 there were lines to do that. Unless the timber is completely destroyed, you need to make a genuine effort. You're obliged to make a genuine effort to salvage it. Keep in mind this is a separate transaction from the loss. If you cannot sell the salvageable timber, for example, if it was a widespread damage like an ice storm, or a hurricane, and there's so much material on the market that you weren't able to sell yours, you need to keep records that show you that you did make a bona fide attempt. All right, again, justifying the numbers that you put on your tax forms. Now, how to calculate your casualty loss deduction? To do that, it's basically the same as if you had sold the timber. You need to identify the single identifiable property, or what the IRS calls the SIP, that was damaged or destroyed beyond use. Now, before 1999, there were two revenue rulings, 66-9 and 73-51. See, these are pretty old, that identified the single identifiable property as the individual trees that suffered mortal injury. Isn't that a poetic term? But in lengthy cases against the IRS, there were 3 forest industry firms that successfully argued that the correct measure of timber that they lost in natural disasters was the district or block that they used to keep track of their adjusted basis. Okay, so we had one of these was a Weyerhaeuser from Mount St. Helens, okay, and the district or block that they used to keep track of their basis was their whole western holdings. Another one was Hurricane Hugo that West Vaco used, how they kept track of their block. The block that they used to keep track of their adjusted basis was their whole southern holdings. Okay, so these are big blocks, lots of money in them. In response to the cases, the IRS issued Revenue Ruling 9956, which revoked those 2 earlier revenue rulings and defined that single identifiable property then as the block that was directly affected by the casualty. So I used to teach both the traditional and the block methods, so you could choose the one you felt more comfortable with during the transition period. But in 2002, the IRS won a court case in which it argued that only the block method was the correct one to use. So the transition period is over now. We need to switch over to the block method. The good thing, though, is that the block method is easier to use than the traditional method was, and it usually allows for a larger casualty loss deduction as long as you have basis in your timber account. So there's just 3 steps. First of all, determine your adjusted timber basis in the block on which the loss occurred. Now, if you keep track of the adjusted basis of all your timber in one account, for example, like these big companies did, you use the total amount in that account. So it's all your basis and all your timber. The second step is to determine the difference in the fair market value of that block immediately before and immediately after the loss. So unless it's some tremendous loss on a great big holding that you have, this is going to be the fair market value of the stumpage that was destroyed. The figure for the fair market value immediately before and after the loss should include the value of any salvageable timber in the block so that you don't overstate the amount of your loss. The third step then is to compare the results from steps 1 and 2, and your deduction is the smaller of the 2 amounts. All right, so it's going to be your the value of the timber that was destroyed up to the limit then of your basis in that timber, or your basis in all your account. So let's work through an example and see how that goes. Let's say 10 years ago you acquired a 40-acre loblolly pine plantation for a total cost of $20,600. See, I've got all your investment down south. The trees were just 8 years old, but you assigned use to their value to the years of growth and allocated $15,800 to your land account and $4,760 to your timber account. So you assigned them some value to just be in there and having some growth on them. So last year, 17 acres of those trees were completely destroyed by a fire. Immediately before the fire, the entire plantation contained 640 cords of pulpwood, of which the 17 acres that were burned contains 272 cords. Also last year, a neighbor sold similar pulpwood for $14 a cord. So let's calculate your casualty loss deduction and your new adjusted timber basis in the block. So step one, determine your adjusted basis in the block. It's $4,760, right? That was a given. Second, determine the difference between the fair market value of the block immediately before and immediately after the loss. So you had 272 cords that were destroyed, and their fair market value is $14 per cord. You got that from your neighbor's sale. That was your comparable. So 14 times 272 is $3,808. So what's your deduction going to be for step 3? It's going to be this, right? Because it's your basis in the timber that was lost up to the limit of your total basis in the block, right? So this is the smaller of the two. So your deduction is $3,808. So your new adjusted basis is going to be your original basis minus your deduction. So you're only going to have $952 of basis left in that account when you have a sale, a timber sale. All right, because the block method generally allows for a larger deduction than the traditional method, the next time you do harvest timber from the block, your adjusted basis in the timber that you harvest is going to likely be lower than under the earlier revenue rulings, and your taxable income then is going to be higher. Destruction of a pre-merchantable stand or plantation may result in a deductible loss if two things. First of all, you keep a separate account for it, and you have costs allocated to that account. The unit of measure is going to be acres. You have no deductible loss if the death of the seedlings is not due to a casualty. There's a revenue ruling about that. I'm not really sure what it means, but there is a revenue ruling. You ordinarily deduct a casualty loss in the year for your tax forms for the year that the loss occurs. If the loss resulted from a presidentially declared disaster, though, you can choose to deduct the loss on an original or amended tax return for the year immediately before the year the disaster took place. So, for example, for all the hurricanes that devastated Florida and Alabama, okay, just knocked down a lot of timber down there. This year, they're preparing their tax returns for 2004, right, this spring. Now, because that was a presidentially declared disaster, they can take that loss deduction, well, they would anyway, on their 2004 return. Before this year, they could have filed an amended return for 2003 and taken the deduction on an amended 2003 return. So that's what I should have said, and got it earlier. Okay. So what that does is it prevents them from having to wait a year in order to take the deduction. Okay. So it took me 2 goes to get that. In addition, the IRS may postpone for up to 1 year certain tax deadlines. For example, the deadlines for filing tax returns or making IRA contributions for taxpayers affected by a presidentially declared disaster. Now, if you receive a federal disaster relief grant or have a federal disaster loan canceled as partial reimbursement for a casualty loss, you subtract the amount of assistance from your loss. You do not report it as income. You do not pay taxes on it. Okay, so that was casualty loss deduction. The next type of involuntary conversion is a non-casualty loss. This is also caused by natural or outside forces, but it only needs to meet 2 tests. It needs to be unexpected, and it needs to be unusual. It doesn't have to be what? Sudden, right, it doesn't have to be sudden. So it can be gradual or progressive. It can be things like disease, insect infestation, drought, or combinations of factors where a drought might make the trees not vigorous and then insects attack them, or they get a disease and die over the course of several seasons. Okay, to take the loss deduction, you follow the same steps as you would with a casualty loss. The difference is in the tax treatment. All right, casualty losses are deducted from ordinary income first, if you have ordinary income. All right. A non-casualty loss, though, is deducted first from capital gains, if you have capital gains. And this is a disadvantage, of course, because capital gains receive favorable tax treatment, and you rather hold those aside and pay the lower rate on the capital gains. Okay, the third type of involuntary conversion is theft loss. Another name for that is timber trespass. To take a deduction for theft loss, you follow the same steps as you would with a casualty loss, with just a couple of exceptions. First of all, you deduct the theft loss in the year that you discover it. So you don't have to go back and figure out when the loss occurred and file an amended tax return for that year, okay, which is a good thing if it occurred more than 3 years ago. Also, the quantity of timber that you use to calculate your depletion unit is the quantity at the time you discover the theft, which is reduced by the amount of the theft, right? Okay, so what this does is it actually increases your depletion deduction, okay, because you're dividing your basis by a smaller number. Treatment of reimbursements also may be more complicated. If you identify and successfully prosecute the guilty party, you need to treat the court award of multiple damages or punitive damages as two parts for taxes. First of all, there's the reimbursement. For example, if you get triple damages, 1/3 of that is the reimbursement for the actual damage, right? That you subtract from the loss. And then the damage award, the punitive part, the 2/3, for example, of triple damages, that's ordinary income to you, so that's taxable to you. Okay, the fourth type of involuntary conversion is condemnation. Now, the tax treatment is the same for a condemnation whether the property actually goes all the way through the condemnation process or if you go ahead and sell it to the government under threat of condemnation. So it's not required that you go through the whole process. Condemnation for a right-of-way easement where you keep title to the land but lose the right to grow timber on it is treated the same as if you had sold it. Condemnation differs in two ways from other forms of involuntary conversions. First of all, it always involves your basis in the land, and the other forms don't because you still have the land. In a condemnation, you either lose the land or you lose the use of it. Okay. Also, it may not involve your basis in the timber. So you deduct if you're allowed to sell the timber, for example, if the government wants your land in order to build a lake and they don't want a bunch of snags in there and they let you cut it first, okay, cut the timber first, then you deduct your basis in the timber from your proceeds from the sale. So you deduct the basis in the land in the year the condemnation occurs. You also deduct the basis in any timber you're not allowed to sell. But you apply the basis in timber you are allowed to sell against the sale returns so that no basis from that timber is going to be left to deduct for the condemnation. So let's use an example to see how this works. Let's say earlier this year you purchased a 50-acre timber tract for $68,000. You allocate $22,300 to the land account and $45,700 to the timber account. Now 5 acres have been condemned for utility right away. You're allowed to sell the standing timber. That's $25,000 out of 190,000 board feet because they're going to put up a power line. They don't want the trees there anyway, right? But you're going to lose the right to grow timber there in the future. So let's calculate your loss deduction. So you deduct your basis in the land from the condemnation award. So that's this is like the equivalent of a depletion unit for the land. You have $22,300 of basis in the land divided by 50 acres total, so that's your investment per acre, right? It's going to be what's inside the parentheses. And then you multiply that times the number of acres that you actually lose the use of. So that's $2,230. But you apply your basis in the timber against the sale returns. So here's your depletion unit for the timber. Here's your timber basis, total timber basis, divided by the total volume that's out there. So that's your investment per 1,000 board feet, right? And then you multiply that times the number of 1,000 board feet that you're allowed to sell on those 5 acres. So you have a depletion deduction of $6,013, but you apply it against the sale return, your sale proceeds, and none's going to be left to deduct from the condemnation award. Okay? So that's different both ways from the other types of involuntary conversion. Also, no further deduction is allowed for the loss of future timber income, so hopefully you got adequately compensated for that. Treatment of expenses. Now you deduct the cost of determining a casualty, non-casualty, or theft loss. So this would be things like timber appraisals, timber cruises, like that. You deduct those as expenses. You do not add them to the amount of the loss. But you deduct your costs incurred to receive a condemnation award from the amount of the award and report the net award then on your tax return. Treatment of gains. Now here's the only glimmer of less bad news. If your salvage sale proceeds, reimbursement, award, or other compensation from an involuntary conversion is more than your adjusted basis in the timber affected, and like we said, that's almost guaranteed, right? You're going to have a taxable gain, so we're not to the good part yet. A taxable gain, further, is just about guaranteed in the event of a salvage sale, since, as I noted earlier, your loss deduction and your salvage sale are separate events. So let's work through an example. In the casualty loss example above, let's say the trees were salvageable rather than completely destroyed by fire. You're able to locate a buyer who pays you $3,000 for the whole thing. You have $500 of deductible expenses from the sale. Remember, your new adjusted basis in the block is only $952, and the entire plantation contains 640 cords of pulpwood, and 272 of those total were burned. So your taxable gain is going to be your depletion allowance. First step in that is your timber basis divided by your pre-harvest volume. So that's your unit, that's your investment per unit of timber times the number of units that are sold. So you have this little tiny basis here divided by 640 cords times the 272 that you're selling. So you only have a depletion deduction of $405, right? Because you've used up most of your basis in the casualty loss deduction. So your taxable gain is going to be your sale proceeds minus your expenses of the sale and the depletion allowance. You're going to have, remember the earlier examples, you had a great big return. You actually received a great big amount of money, but you were able to write most of it off as a depletion deduction, and your taxable income is a relatively small part of the total. But here, since your basis was mostly used up in the casualty loss deduction, you only have a very small depletion allowance, so almost most of your sale proceeds are taxable income. So this is what happens after the first three sales or losses. Okay, now here's a little glimmer of good news. But you can defer recognition of and the income tax on that gain by using it to purchase qualifying replacement property within the allowable replacement period. Okay, so now you have two questions, right? Which are what? What is qualifying replacement property, and what is the allowable replacement period? So qualifying replacement property includes things like replacement seeds and seedlings, replanting costs on land that you own or lease or buy. It also includes restoration work to repair damaged, clean and clear drainage systems, or replace culverts, fences, gates, and roads to restore the land to its pre-damaged state. Also the stock to acquire or gain control of a corporation that owns timberland, or both. So we could go out and take your gain and buy stock and warehouse it, right? And the allowable replacement period, that's the second question. For a casualty, non-casualty, or theft loss, the allowable replacement period is 2 years after the close of the first tax year in which you realize any portion of the gain. Okay? Now you have to read this about 3 times, but after you read it about 3 times, you can understand what that says. For a condemnation, the allowable replacement period is 2 years after the close of the first tax year in which you realize any portion of the gain for personal property, and 3 years after the close of the first tax year in which you realize any portion of the gain for real property. The rub comes with timber is generally considered real property, which would give you 3 years to replace timber that you lose in a condemnation, right? But timber that's under contract for sale in some states that have adopted the Uniform Commercial Code, that considers timber under contract for sale to be personal property, not real property. So if you have timber under contract for sale, unless you know that your state is not one of the states that has fully adopted the Uniform Commercial Code, you want to go ahead and replace it in 2 years, okay, after the close of the first tax year in which you realize any portion of the gain. The deal here is realizing any portion of the gain from a salvage harvest starts this clock ticking. In a lot of cases, it's 2 years. If it's real property, it's 3 years that you lose in a condemnation. It's a 3-year clock. But if it's timber under contract for sale, it may be a 2-year clock. All right. So if what you lost in a condemnation is timber that was under contract for sale, assume you have a 2-year clock and go ahead and replace it. Don't put yourself at risk. Okay, in order to postpone recognition of the gain, you attach a statement to your tax return on a Form 3P, the plain piece of paper. State that you elect to postpone recognition of that gain, and you've described the conversion and the replacement property. The amount that you defer cannot exceed the fair market value of the assets that were lost. Okay, so you cannot hide income here. Also, your basis in the replacement property is its cost, which it would be ordinarily, minus the amount of the deferred gain. So what that does is it reduces your basis in the replacement property, and if you sell or convert that property, your taxable income is going to be higher. So it doesn't do away with recognizing that gain, it just postpones it. Okay? Okay, here's the forms for use with a involuntary conversion. This is a Form 4684, Section B. You notice this doesn't look like the front of a form, right? This is the back of a form, but it's Part 1, casualty or theft, gain or loss. Okay, so you start here if you have a casualty, non-casualty, or theft loss. Okay, this is where you go. This is the place to report a non-casualty loss, even though the form does not mention non-casualty loss. All right, so you can see there's 4 columns here, so you can do the calculations for losses on up to 4 properties that are caused by the same event on a single Form 4864. Okay, if you have damage on more than 4 properties, or you have damage from more than one event, you're really an unfortunate individual, but you need to go to additional forms. Okay, so you can't mix events on a single form. You need to use only one form per event. You calculate your net short-term or long-term gains or losses on this form, just like it says. If you hold the property for business, rental, or royalties, you go from here to Form 4797 Part 2, and we've already seen 4797 several times. If you hold the property as an investment, you're going to go here from here to Form 1040 Schedule A, but it goes under other miscellaneous deductions that are not subject to the 2% floor, 2% of AGI. Okay? So you don't have to worry about the 2% of AGI and lose that part. It's an other miscellaneous deduction. The other form you use for involuntary conversions is a 4797. Okay, this is where you go if you have eventually, second step, if you have a casualty, non-casualty, or theft loss. But this is where you start if you have a condemnation up here in Part 1. You also report it on Form T Schedule D. That would be 4, not D. And you're going to go from here to Form 1040, the other gains or losses line, and you write in from Form 4797. Okay, I'll stop there. Are there questions with involuntary conversions?